Question 7. How does the PULS ETF manage risk? The PULS ETF, PGIM Ultra Short Bond ETF, employs several strategies to manage risk and potentially achieve its investment objective of total return. 1. Focus on ultra-short-term bonds. Reduced interest rate risk. The core risk management strategy of PULS lies in its focus on ultra-short-term bonds, typically with maturities of less than 3 years, often within 1 year. These bonds are less sensitive to interest rate fluctuations compared to longer-term bonds. Here's why. Limited time to interest rate impact. Since these bonds have maturities approaching very soon, even if interest rates rise, the investor gets their principal back quickly and can reinvest at the prevailing higher rates. The shorter duration minimizes the potential price decline caused by rising interest rates. Lower initial interest rates. Generally, shorter-term bonds offer lower interest rates compared to longer-term bonds. This means that even if interest rates rise slightly, the impact on the existing price of the bond might be smaller due to the already lower starting interest rate. 2. Investment-grade bond selection. Credit risk mitigation. PULS primarily invests in investment-grade bonds. These are bonds issued by governments or companies with a high credit rating, indicating a lower probability of default, failure to repay the principal or interest. By focusing on these higher quality bonds, PULS aims to minimize the risk of losses due to defaults. 3. Active portfolio management. Beyond index tracking. Unlike some ETFs that passively track a specific bond index, PULS is actively managed by a team of portfolio managers. This allows them to make strategic decisions to manage various risks within the ETF. Risk management strategies. The portfolio managers can employ various strategies to manage risk. Diversification within short-term bond universe. They can diversify the holdings within PULS across different issuers, sectors, and maturities within the ultra-short-term bond category. This helps spread out credit risk and potentially reduces the impact of a single issuer defaulting. Maturity staggering. The managers can strategically choose bonds with slightly different maturities. This helps maintain a steady flow of income as bonds mature and can also be used to potentially position the ETF to benefit from rising interest rates. For example, they might hold some bonds maturing closer to a time when interest rates are expected to rise, allowing them to reinvest at higher rates. 4. Expense ratio management. Cost efficiency. While expense ratios are inherent to any ETF, keeping them low is crucial for PULS, especially since it might generate lower overall returns due to its focus on short-term bonds. PGIM, the issuer of PULS, keeps the expense ratio relatively low, currently 0.15% as of April 25, 2024, to help maximize potential returns for investors. It's important to remember that these risk management strategies can help mitigate risks, but they don't eliminate them entirely. Market conditions, unforeseen events, and management decisions can still impact the performance of the PULS ETF. Here are some additional points to consider. Limited diversification. Compared to a broader bond fund or a diversified portfolio, PULS offers limited diversification by focusing solely on the ultra-short-term bond segment. This can expose investors to higher concentration risk if the entire short-term bond market experiences a downturn. Lower potential returns. The trade-off for lower risk through short-term bonds is generally lower potential returns compared to longer-term bond funds. Investors seeking higher potential returns might need to consider including other asset classes in their portfolio alongside PULS. Question 8. How is the PULS ETF exposed to different asset classes or sectors? The PULS ETF, PGIM Ultra Short Bond ETF, has a very narrow exposure to asset classes and sectors. By design, it focuses almost entirely on a single asset class, fixed income. More specifically, it invests in a subsegment of the fixed income market, ultra-short-term bonds. Here's a breakdown of PULS's asset class exposure. Fixed income, primary exposure. Ultra-short-term bonds, PULS primarily invests in investment-grade, US dollar-denominated, ultra-short-term bonds. These can include Treasury bills, short-term debt obligations issued by the U.S. government with maturities of less than 1 year. Commercial paper, unsecured, short-term debt obligations issued by corporations. Money market instruments, short-term debt instruments issued by various entities, such as certificates of deposit, CDs, and commercial paper. Asset-backed securities, ABS. These are financial instruments that pool together short-term debt obligations like car loans or student loans, and then sells them as a security. Minimal exposure to other asset classes. There might be negligible exposure to other asset classes like equities, stocks, or real estate within PULS. This is because the focus is on generating income through fixed income instruments with short maturities. Sector exposure within fixed income. Even within the fixed income universe, PULS has a limited sector exposure due to its focus on ultra-short-term bonds. Here's why. Limited time to maturity. Since these bonds have maturities of less than 3 years, often within 1 year, the specific sector of the issuer, e.g., financials, technology, becomes less relevant compared to longer-term bonds. The focus is on the creditworthiness of the issuer and the short-term nature of the debt obligation. Potential sector diversification. However, there might be some level of underlying sector diversification within PULS. The portfolio managers could choose ultra-short-term bonds issued by companies or government entities across various sectors. This diversification helps spread out credit risk and potentially reduces the impact of a single sector experiencing financial difficulties. Implications for investors. Limited diversification. The narrow focus on ultra-short-term bonds within a single asset class, fixed income, means that PULS offers limited diversification compared to a broader bond fund or a diversified portfolio that includes various asset classes. This can expose investors to higher concentration risk if the entire short-term bond market experiences a downturn. Matching investment goals. If your investment goal is to generate a steady stream of income with minimal risk and volatility, PULS's focus on short-term bonds can be a suitable option. However, if you seek higher potential returns and broader diversification, you might need to consider including other asset classes in your portfolio alongside PULS. Question 9. How concentrated are the holdings within the PULS ETF? The concentration of holdings within the PULS ETF, PGIM Ultra Short Bond ETF, can vary to some extent, but it generally has a higher concentration compared to many other ETFs due to its specific investment strategy. Here's a breakdown of the factors influencing concentration. Factors contributing to concentration. Limited investment universe. PULS focuses on a narrow segment of the bond market, ultra-short-term bonds, typically less than 3 years, often within 1 year. This inherently limits the available universe of potential investments compared to a broader bond fund that might encompass various maturities and sectors. Active management. Unlike passively managed index ETFs, PULS is actively managed by a team of portfolio managers. These managers have discretion in selecting which specific ultra-short-term bonds to include within the ETF. While diversification is a goal, they might choose to concentrate holdings in specific issuers or sectors based on their investment judgment. Potential benefits of concentration. Targeted exposure. In some cases, concentration can be a benefit. The portfolio managers might choose to concentrate on specific issuers or sectors within the ultra-short-term bond market that they believe offer the most attractive potential returns relative to risk. Potential drawbacks of concentration. Higher concentration risk. The primary concern with concentration is the increased risk associated with a single issuer or sector experiencing financial difficulties. If a significant portion of the PULS holdings are from a single issuer or sector that defaults, it could cause a larger decline in the ETF's price compared to a more diversified fund. Question 10. Are there any restrictions on the types of securities the PULS ETF can hold? Yes, there are some restrictions on the types of securities the PULS ETF, PGIM Ultra Short Bond ETF, can hold. These restrictions are outlined in the ETF's investment objective and prospectus. Here's a breakdown of the key limitations. 1. Focus on fixed income. Primary investment target. PULS is designed to invest primarily in fixed income securities, specifically bonds. This means the ETF cannot hold any equities, stocks, real estate investment trusts, REITs, commodities, or other asset classes outside the bond market. 2. Investment grade focus. Credit quality threshold. PULS primarily focuses on investing in investment grade bonds. These are bonds issued by governments or companies with a high credit rating assigned by independent credit rating agencies like Moody's or S&P Global Ratings. A high credit rating indicates a lower probability of default, failure to repay the principal or interest. While there might be some exceptions, the prospectus likely restricts the inclusion of bonds below a certain investment grade threshold. 3. Maturity restrictions. Ultra-short-term focus. The defining characteristic of PULS is its focus on ultra-short-term bonds. The prospectus likely specifies a maximum maturity limit for the bonds held within the ETF. This maturity limit is typically less than 3 years, often within 1 year. There might be flexibility within this range, but the overall objective is to maintain a portfolio with a very short average maturity. 4. Currency denomination. Focus on US dollar. The prospectus likely restricts PULS to investing in US dollar-denominated bonds. This avoids the additional risk of foreign currency fluctuations that can impact the value of the ETF. 5. Other potential restrictions. Additional exclusions. The prospectus might also outline other specific exclusions on the types of securities PULS can hold. These could be related to specific industries, issuer types, or other factors deemed unsuitable for the ETF's investment objective. Question 11. Are there any other ETFs or mutual funds that offer similar investment exposures to the PULS ETF? Yes, there are several ETFs and mutual funds that offer similar investment exposures to the PULS ETF, PGIM Ultra Short Bond ETF. Here's a breakdown of some potential options. ETFs with similar exposure. SPDR Bloomberg Barclays 1 to 3 year U.S. Treasury Bond ETF, SHY. This ETF tracks an index of U.S. Treasury bills, notes, and bonds with maturities between 1 and 3 years. Similar to PULS, it focuses on the short-term U.S. government debt market but might have slightly lower expense ratios due to its passive management approach. iShares Short Treasury Bond ETF, SHRT. This ETF also offers exposure to short-term U.S. Treasury securities with maturities of 1 to 3 years. It's another passively managed option with a potential expense ratio advantage compared to PULS. Invesco Ultra Short Duration Bond ETF, USD. This ETF invests in a broader range of investment-grade, ultra-short-term bonds issued by governments, corporations, and other entities in the U.S. market. It offers similar exposure to PULS's target maturity range, but with potentially slightly more credit risk due to the inclusion of non-government issuers. Mutual funds with similar exposure. Fidelity Ultra Short Bond Fund, FXSHX. This actively managed mutual fund invests in a portfolio of investment-grade, ultra-short-term bonds similar to PULS. While the expense ratio might be slightly higher than PULS, it offers the potential benefit of active management. Vanguard Ultra Short-Term Bond Fund, TUS. This passively managed mutual fund tracks an index of short-term U.S. Treasury securities. It provides a low-cost option for investors seeking exposure to this specific segment of the bond market. Schwab Short-Term Bond Fund, SWSHX. This actively managed mutual fund invests in a diversified portfolio of short-term bonds, including U.S. Treasuries, investment-grade corporate bonds, and money market instruments. It offers broader exposure than PULS, but with potentially slightly higher credit risk. Question 12. Can a similar investment strategy be achieved by directly investing in underlying assets? Yes, it's possible to achieve a somewhat similar investment strategy to the PULS ETF, PGIM Ultra Short Bond ETF, by directly investing in the underlying assets, ultra-short-term bonds. However, there are some key considerations to keep in mind. Challenges of direct replication. Transaction costs. Purchasing individual bonds can involve transaction costs, including commissions and fees charged by brokers. These costs can eat into your returns, especially for ultra-short-term bonds with lower potential interest payments. Minimum investment amounts. Some bonds, particularly those issued by corporations, might have minimum investment amounts that could be high for individual investors. PULS and similar ETFs offer fractional shares, allowing investors to participate with any amount. Diversification challenges. Building a diversified portfolio of ultra-short-term bonds across different issuers and maturities can be time-consuming and require ongoing research and monitoring. PULS and similar ETFs offer instant diversification within a single holding. Liquidity considerations. While many bonds are fairly liquid, there's always a chance that you might face difficulty selling a specific bond before its maturity if needed. ETFs generally offer higher liquidity compared to individual bonds. Possible strategies for direct investment. Focus on Treasury bills. U.S. Treasury bills are short-term government debt obligations with maturities of less than 1 year. These can be purchased directly through Treasury Direct, a government platform, eliminating some transaction costs. However, they may offer slightly lower potential returns compared to corporate bonds. Utilize bond ladders. A bond ladder involves investing in a series of bonds with staggered maturities. As each bond matures, you can reinvest the proceeds into a new bond with a longer maturity, helping to maintain a steady stream of income and potentially manage interest rate risk. However, this strategy requires ongoing management and may not be as efficient as an ETF. Consider short-term bond funds. Some actively managed mutual funds also focus on ultra-short-term bonds. These funds can offer some diversification and potentially outperform a strategy of directly buying individual bonds due to the manager's expertise. However, they typically have higher expense ratios compared to ETFs. Alright everyone, that wraps up our exploration of the PULS ETF. So, what's the verdict? The PULS ETF can be a good option for investors seeking a steady stream of income with minimal risk and volatility. Its focus on ultra-short-term bonds minimizes interest rate risk and prioritizes credit quality. However, keep in mind the limitations. The expense ratio might eat slightly into your returns, and the diversification is limited compared to a broader portfolio. If you're interested in a similar strategy, we explored some alternatives like the SHY ETF or actively managed short-term bond funds. Remember, the best choice depends on your investment goals and risk tolerance. Before you jump in, do your own research and consider consulting a financial advisor. No matter which path you choose, Hopefully this video has equipped you with the knowledge to make informed decisions about bond investing. Let us know in the comments below if you have any questions about the PULS ETF or bond investing in general. Thanks for joining the conversation. Until next time, keep chatting ETFs.